Hello and welcome to BQ Prime. You're watching IPO Adda. The company in focus is today's Senco Gold. It's a Kolkata-based company coming out with its IPO, which opens on July 4th and closes on July 6th. Price between 301 to 317, giving the company a market value of 2,461 at the upper end of the price band. And joining me is Suvankar, who is the CEO and MD, and Mr. Sanjay Banka, who is the CFO of the company. Gentlemen, thank you very much for joining us on BQ Prime. Mr. Sen, let me begin with you. You're raising nearly 405 crores, which includes 270 crores of fresh capital and 135 crores, which is a selling shareholder exiting through an OFS. What is the use of this 270 odd crores that you're raising?
So the 270 crores is for working capital for the growth of the number of stores that we would like to do. So this is how we are utilizing the 270 crores.
Okay. Is it possible for you to articulate, what kind of working capital requirement is required, and what is the store expansion strategy that you have?
So see, we cannot talk too much about the future, but what we can tell you is that for opening a store, it takes around 16 to 18 crores in terms of inventory and around 1.5 to 2 crores in terms of capex. So whatever the store interiors and the machineries to put it in the store. So this is what you need for a store. So this is how we would like to move forward.
So how many stores are you planning to open?
We see, if you see the historic numbers, every year we have been able to open around 5, 6 company-owned, company-operated stores and around 4, 5 franchisees. So this is something, Sajid sir, that you must take note of, that we are one of those few jewelry companies in the country that is a very robust franchisee model. Out of the 136 stores that we have, 75 are company-owned, company-operated, and the remaining 61 are franchisees. Now, for the franchisees, we need not put our investment in inventory or the capex. It is the franchisee that puts in the money. So we need to focus on brand building and building the company and company operated stores in the bigger cities of the country, and get the leads of the franchisees from the smaller towns, the tier 1, 2, 3, 4 cities. And that is how the expansion can happen in a very scalable manner. So this is what we have done in the past as well, and we would like to continue to follow a similar pattern in the future.
Mr. Banka, can you take us through the franchisee economics here? I mean, how much, what kind of, revenue do you get, and what kind of revenue share that you have with them?
Yeah. So our franchisee model is a very successful franchisee model and perfected over last 15 years. We have around 60 plus franchisee model. In fact, there are certain franchisee who have taken more than 6 to 7 franchises. So the secret clearly lies in a win-win relationship. So a franchisee usually need to invest in the inventory. So it's a cash and carry model. Franchisee needs to invest around 10 to 12 crore rupees in the business, around 8 to 10 crore in the inventory, and around 1 to 2 crore in the capex of the store. Now, the secret of the business is inventory turnover. A franchisee does a minimum inventory turnover of 2 in the year 1, and then 2.5 to 3 in third year. Franchisee makes around 7 to 8% gross margin. So when 10 crore is multiplied by 2, then it becomes 20 crore, and then gross margin 6. So 1.2 crore is the gross margin. He has certain OPEX, and then he starts earning his profit. So by third year, he starts earning around 15 to 18% return on equity at a PBT level. So by third year, he becomes stable, and the return for the franchisee, it is not only the return. There are multiple advantages for him. He enters into strong relationship with the company, future business expansion. And gold jewelry is the only industry where the person is very secured. It's a very liquid asset. There's no risk on the inventory. So, and third point is that the inventory always appreciates. So these are the multiple things in which franchisee invests in the company. And in our case, a franchisee enjoys, he's not just a franchisee, he's a family member. So most of our franchisee are treated as a family member. That's why they have continuously grown with the company, and that is a success story. And the franchisee model is what is giving us a superior gross margin, superior return on net worth, and the capital appreciation for all of us.
How do you account for?
Just add on to what he said. So when it's your company-owned, company-operated store, your gross margins is in the range of 18%. And when it's a franchisee, the company, Senco, keeps 7% to itself and passes on that 11-12% to the franchisee. So this is how the sharing of the margins are happening. And then whatever he said in terms of the how many times the stock is turning. So 12% into say 20 crore kind of a turnover if he does, that's 2.5 crores of gross margins that he's making. And then it's usually in a tier 1, 2, 3, 4 city, the costs are within controls. Then you reduce it, and then that is how the nets are.
Give me a sense of how do you account for revenues here in this sense,
So
in the franchisee model?
revenue is accounted for upfront. We franchisee usually pays cash first, and then he takes the inventory, and it is recorded as inventory. So inventory does not lie in our books; it lies in the franchisee books.
And it
So
is
it's basically just to get an understanding, it's basically gross merchandise value that you account as revenues here.
Yes, correct.
Gross merchandise value as a net after. So suppose if it is 100 rupees and we sell to them at say 88 rupees, that is what we book in our revenue when we sell it to them, and then the 12% is on them. So this is how we would look at it. And also, Sajid sir, this reason, as Mr. Banka said, if you look at our stock turnover ratio, the number of days, 150 odd days. So it is because of that the customer touch points that we create. So if there is a requirement of stock in a franchisee, we take it from our hub own store and sell it to them. If there is a requirement from another store, we shuffle it from store to store. So this free movement of goods between store to store allows us for a very high stock turnover ratio.
Okay. And when you talk about the working capital requirement, because is it only with respect to having working capital to create inventory, or is it for other purposes as well?
So when we say working capital, our working capital is primarily for inventory. So let's say our inventory itself is 1800 crore plus in a balance sheet of 2900 crore, and our borrowing is 1150 crore approximately. But a certain part of working capital is also required for placing margin with the banks. But primarily, when we say working capital, it primarily means inventory and jewelry to be placed at the store, and we don't have any long-term borrowing or any long-term debt.
Because Sajid sir, one of the important aspect of our business is the gold metal loan that we get from the banks. That is the what you need as raw materials for your products, as well as it is a form of a loan. So this is what is the main requirement for the working capital.
How do you account for gold volatility, especially with respect to prices?
So basically, we are now adequately and properly hedged. We have a very strong hedging policy which has been approved by the board and this committee. And moreover, no, our private equity partners, they also have played an important role in helping and guiding us. So due to this hedging policy adopted by us, we are not impacted by the gold price movement in a very material way. So when the price falls, we don't have any loss on the balance sheet. And similarly, when the price increases, we don't have any gain. So we keep as a part of our hedging policy, a major part, let's say 40 to 50% hedging is done by gold metal loan, which we keep unfixed. So there's a complex decision on that. So by keeping the gold metal loan price unfixed, we are not impacted. If the price falls, we pay a lesser price to the bank. If price rises, we do a higher price to the bank. Point one. Point two, balance of the hedging we do by a future transactions at the MCX. So this is in line with the best industrial and global practices.
So, give me a sense of how same-store growth has been doing for you. You have roughly, if I'm not wrong, 90% of your sales coming from gold jewelries. You've seen your peers moving away from gold jewelry to studded jewelries. What is your strategy there?
So 85% of our business is 22 carat like pure gold jewelry. Around 10-11% is our business from the diamond studded jewelry, and 3% or remaining business is the platinum, silver, and other kind of jewelry. And if we look at the past, sir, in the first wave of COVID, we grew by about 10% from 2,400 crore to 2,600 crore. Then in the second wave, after that year, we grew by 35% from 2,600 crore to 3,500 crore. And last year, we grew by 15%, which is from 3,500 crore to 4,000 crore. So this has been a mix of, same-store sales growth as well as a few stores that you keep adding. But in the first year of, when the few stores gets added, that does not add to a huge number, because it takes for the store about 2 to 3 years to start really generating the adequate amount of, sales. So this is how it is. The same store store growth has been in the range of, I would say, 10 to 12%.
Mhm. If I'm not wrong, the gross margins that come in from franchises help you as well in terms of EBITDA margins. Your
Yeah.
EBITDA margins were around 7.8% for FY23, has been stable for last 2 years. Is there a way that you have levers within your company to increase the EBITDA margin to beyond
Yes,
8 or
sir.
10%?
So like you rightly said, the diamond jewelry sale, that is a major lever. Last year, we grew by almost 35% in diamond jewelry itself. And if you look at the last 4 to 5 years, we have grown almost double that overall diamond jewelry sales. So such has been the growth. So that is a major tool with which we are working.
So,
And yes, Mr.
yeah,
Banka.
just to add to here, like as the business grows, we the OPEX cost or the variable cost will not increase in the same proportion in the past also. So while the gross margin will continue to increase in the past also, the OPEX have been kept in control, and this comes from our strategic locational advantage of Kolkata being a land of Karigari. Our making charge obviously are much lesser than, because it's a Bengal Karigar who are spanned across pan India, so that cost is lesser. So due to the strategic locational advantage, our cost structure is lower, which will help us grow the EBITDA margin disproportionately versus the gross margin increase. And that's what is
What
the trend in the past.
about expansion into other regions, north, west, and south?
So again, if we look at the historical figures, sir, around 70 to 80% of our stores are in eastern part of the country. Around 15% of the stores are in northern part of the country, and the rest 5-6% is in the western and the southern part of the country. And I think as we continue to grow, we will try to keep on focusing on the similar kind of a pattern.
You haven't entered the western and the southern part of the country where you have the maximum amount of demand for gold and gold jewelries, while northern side is where we see normally good demand coming for studded jewelries, which is
Right.
there. So why what is the reason why your penetration, or you've been slow to enter these two competitive markets, south and west?
So as you very well pointed out, that the markets are competitive. We are strong in the eastern part of the country, and we believe, like the DMart strategy, to leverage our goodwill, our strength, and penetrate deeper into the tier 2, 3, 4 cities where we are already strong, so that we get the return on our capital and the goodwill and the leveraging of and economies of scale. That is one. Second, the gross margin has to be critical, and North India is, as you said, is the focus of studded ratio. So the future of business profitability will come from higher studded sale. So therefore, we would like to focus on eastern, on the northern part of the country to begin with. After the asset allocations are done in a manner that the returns are coming, again, we will surely look into western part of the country in terms of the business growth. So this is how we're looking at it. Southern part, we will come in a staggered way, in a strategic manner, because there is anyway a lot of competition. There are a lot of brands. So we would like to focus on the northern part of the country.
Give me a sense of breakup between tier 1, tier 2, and tier 3. Are you only focused to tier 1, or penetrating into tier 2 and tier 3 within the east and northern region? That's what your focus is going to be next
It is it
couple of
is it
years.
is quite evenly distributed, 30, 35, 30, 35, 30, 35. So between my bigger metro cities, the tier 1 and the tier 2, 3, 4 city. It is only because of the franchisee model that our penetration into the smaller towns are being very much possible, in terms of expansion, in terms of management bandwidth, in terms of people running the stores with the sense of ownership. So this is how we would like to continue in the future.
So, is it fair to say that your penetration into tier 2 and tier 3 is more will be franchise led as compared to company owned stores?
Yes, correct, sir, correct.
And if that is the case, that will you be more aggressive in pushing franchisee stores, or will you be looking at pushing more company owned
No,
stores
so
going forward?
see, if you look at again the history, sir, it is in around 75-65. So this is the kind of a breakup. While opening company-owned stores is in our control, we can identify the good location, we can say
Hmm.
this has a market potential, and we can go ahead and do it. For the franchisee, the good location is important. Even a good franchisee partner is very, very important, because we are handing over the goodwill to that particular partner. So while we would also want to grow the franchisee, but getting the right kind of person and mindset is very, very important.
What about, how do you see the growth of gold jewelry versus studded jewelry in terms of percentage growth which you see? And now you have a lot of emphasis coming into alternative investments where gold bonds or sovereign bonds and others are being pushed by the government instead of going for physical
Right.
jewelry. So how do you see these environments impacting your growth going forward?
So what I would say,
Especially in tier one, where financial literacy is increasing on a
yes.
large scale.
So our average ticket size is 60 to 70,000 rupees. We have, say, 4,000 crore turnover. Our number of transaction in a year is around 5.5 lakh crore. So you can imagine, this is our average ticket size that we are doing. It is like a retail company in the business of jewelry. This is how we look at it. So with the increase in gold price, we are actually seeing that our diamond jewelry sales in the last 2-3 years is growing in double digit numbers, 15%, 20%, 25%. So it is in that ratio. It is driven by what? Diamond jewelry is made with 14 karat or 18 karat gold. So therefore, the gold value is going down, plus the customer is able to buy diamond as well. So this is helping the customer to fulfill their dreams, and it is also helping the company to add a little marginal higher impact on the bottom line as well. So this is how we see that the growth of diamond jewelry will be higher compared to the growth of gold jewelry. So this is the outlook that I would like.
Gentlemen, it was a pleasure talking to you today. The Senco Gold Limited IPO opens on July 4th, closes on July 6th. Price between 301 to 317. The company is raising nearly 405 crores, which includes 270 crores of fresh capital. Thank you for watching IPO Adda.
Thank you very much, everyone.